December 17, 2025. The offshore yuan hits 7.04 per dollar, a 14-month high. Analysts scrambling to explain what's happening. Headlines talking about currency manipulation, about China's grand strategy, about the end of dollar dominance. But here's what nobody's telling you. The yuan's strength right now isn't about geopolitics. It's not about some coordinated attack on the dollar. It's about something far more mechanical, far more interesting, and far more revealing about where global finance is actually heading. The Chinese yuan just completed its strongest yearly performance since 2020, up nearly 3.5% against the dollar in 2025. That might not sound like much, but for a currency that's been stuck in a narrow band for years, tightly controlled by Beijing, moving against one of the strongest dollar rallies in decades, this is significant. And the mechanisms driving this move reveal patterns that most people miss completely. Let me show you exactly what's happening, not the story the financial media tells. The actual mechanics, the three forces converging right now that are pushing the yuan higher. Why this isn't temporary, and what it means for the dollar, for global trade, and for anyone holding currency-denominated assets. Because understanding currency movements isn't just academic, it's understanding where wealth flows. And right now, wealth is flowing in a direction that most people aren't watching. Let me start with what's actually moving markets right now. The Federal Reserve, December 10, 2025. The Fed cuts interest rates by 25 basis points, their sixth rate cut since September 2024. The federal funds rate now sits at 3.5 to 3.75%. That's 1.75 percentage points lower than the peak. And every single one of those cuts weakens the dollar and strengthens the yuan. Here's the mechanism most people miss. When the Fed cuts rates, US dollar deposits and bonds become less attractive. International investors holding dollars earn less interest, so they look elsewhere. Some flow to euros, some to yen, and increasingly, some flow to yuan. Not because the yuan pays dramatically higher interest. China's rates are actually relatively low, but because the interest rate differential between the US and China is narrowing. And that matters enormously. In 2023, US rates were 5.5%. Chinese rates were around 2.5%. That's a 3 percentage point spread. Massive. Investors piled into dollars to earn that extra return. The dollar strengthened, the yuan weakened. But now, US rates at 3.625%, Chinese rates still around 2.5%. The spread narrowed to just over 1 percentage point. Suddenly, holding dollars isn't as attractive. The capital flows reverse, and the yuan strengthens. This isn't theory. We've seen this exact pattern play out. From September 2024, when the Fed started cutting, through December 2025, the yuan has appreciated steadily. From around 7.27 to the dollar in September to 7.04 in mid-December. That's a 3.2% move. And it correlates almost perfectly with Fed rate cuts. Every cut, another leg higher for the yuan. But here's where it gets interesting. The Fed isn't done. Fed projections show another 50 to 75 basis points of cuts expected through 2026. If that plays out, the interest rate differential narrows further, and the yuan strengthens more. And this creates a feedback loop. As the yuan strengthens, Chinese companies holding dollar assets start converting them back to yuan. Why? Because they see the yuan appreciating. They want to lock in gains. This was exactly what currency analyst Stephen Jen predicted. He estimated Chinese firms accumulated over $2 trillion in offshore investments since the pandemic. Dollar deposits, dollar bonds, dollar assets, all earning that higher US interest rate. But now the math flipped. The interest rate advantage is shrinking, and the yuan is strengthening, so Chinese companies are converting dollars to yuan. That creates buying pressure on the yuan, which pushes it higher, which encourages more conversions. Self-reinforcing. Jen called this a potential $1 trillion sell-off. It could push the yuan 5 to 10% higher if it accelerates. We're watching the early stages of this right now. Now let me show you the second force. This one's less obvious, but equally powerful. China's foreign exchange reserves. As of November 2025, China holds $346 trillion in foreign exchange reserves, the highest level in a decade. That's not a typo, highest since November 2015. and it's been climbing for 4 straight months. Why does this matter? Foreign exchange reserves are the ammunition central banks use to defend their currency. When your currency is falling, you sell reserves to buy your own currency. That creates buying pressure, stabilizes the exchange rate. When your reserves are growing, it means your currency is strong enough that you don't need to intervene, and it gives you firepower for future battles. China's reserves climbing tells you something critical. The People's Bank of China isn't burning through dollars to prop up the yuan. They're accumulating. That means market forces are naturally supporting the yuan. Capital isn't fleeing China, it's staying, and in some cases returning. This is the opposite of what happened in 2015 and 2016, when China burned through nearly 1 trillion in reserves trying to stop yuan depreciation. But there's another layer. China has been systematically diversifying those reserves, reducing dollar holdings, increasing gold. China's official gold reserves hit 74.12 million troy ounces in November 2025. That's the 13th consecutive month of increases. The value of those gold holdings? $310.65 billion, up from $297 billion the month before. China is quietly, methodically, shifting from dollars to gold. This matters for the yuan because it changes the composition of what backs the currency. Less dollar dependence, more hard asset backing, and as the dollar potentially weakens, gold typically rises. China's reserves become more valuable in dollar terms, which strengthens their position, and by extension strengthens the yuan. Now here's where the People's Bank of China gets strategic. The daily midpoint. Every morning the PBOC sets a reference rate for the yuan. This is where they want the currency to trade. The market can move 2% above or below this midpoint during the day, but the midpoint is the signal, and recently, the PBOC has been setting stronger midpoints. December 16, 2025. The PBOC set the midpoint at 7.0602, the strongest setting since October 2024. This wasn't accidental. The PBOC uses the midpoint to guide market expectations. By setting it stronger, they're signaling they're comfortable with yuan appreciation. They're not trying to weaken the currency to help exporters. They're letting it strengthen. That's a major shift. For years, China was accused of deliberately keeping the yuan weak to make exports cheap. Currency manipulation. The US Treasury used to threaten to label China a currency manipulator, but now the yuan is strengthening and the PBOC is allowing it. Why? Because they have different priorities. They want yuan internationalization. They want reserve currency status. They want global respect for their currency, and you don't get that by constantly devaluing. This brings me to the third force, the one almost nobody is tracking. But it's potentially the most important long-term. The cross-border interbank payment system, CIPS, China's alternative to SWIFT, and it's scaling fast. In 2024, CIPS processed 175 trillion yuan in transactions. That's $24.47 trillion, up 43% year over year. Think about that growth rate. 43% in a single year, and it's not slowing down. Since 2021, CIPS has grown at an average annual rate of 40%. As of June 2025, over 1,700 institutions have joined CIPS, direct and indirect participants, covering 189 countries and regions. This is China building parallel financial infrastructure, and every transaction that goes through CIPS instead of SWIFT is a transaction settled in yuan instead of dollars. Here's why this matters for yuan strength. When a Thai company wants to buy goods from a Chinese manufacturer, they used to pay in dollars. Convert Thai baht to dollars. Send dollars through SWIFT. Chinese manufacturer converts dollars to yuan. 3 currency conversions, multiple fees, days of settlement time. But now, with CIPS, they can pay directly in yuan. Thai company converts baht to yuan. Sends through CIPS. Chinese manufacturer receives yuan. 1 conversion, lower fees, faster settlement, more efficient. And efficiency drives adoption. CIPS isn't growing because countries hate America. It's growing because it's cheaper and faster for yuan-denominated trade. And as more companies use it, more demand for yuan, more need to hold yuan, and that strengthens the currency. This is the network effect. The more people use a payment system, the more valuable it becomes. and CIPS hit critical mass faster than almost anyone expected. June 2025. CIPS announced direct partnerships with 6 major banks across the Middle East and Africa. Standard Bank, African Export-Import Bank, First Abu Dhabi Bank. These aren't small players, these are major regional institutions, and they're now direct participants in yuan clearing. That means companies across Africa and the Middle East can now settle trade with China in yuan without touching dollars, without touching SWIFT. This is huge. Let me show you what this looks like in practice. Saudi Arabia, March 2023. For the first time in 49 years, Saudi Arabia agreed to accept yuan for oil sales to China, not dollars, yuan. This broke the petrodollar monopoly, and it was just the beginning. December 2024. Saudi Arabia joins BRICS. The signal? Diversification away from dollar dependence. And CIPS is the infrastructure making this possible. Chinese oil imports from Saudi Arabia, Russia, Iran, increasingly settled in yuan. Not because these countries love China, but because they want alternatives. They saw what happened when the US froze Russian dollar reserves in 2022. $300 billion frozen overnight. Every country watching understood the message. Dollar reserves can be seized, SWIFT access can be cut. You're vulnerable if you're too dependent on the dollar system. So they're building alternatives, and CIPS is the most viable alternative that exists today. As CIPS scales, as more trade settles in yuan, demand for yuan increases, and the currency strengthens, not dramatically, not overnight, but steadily, persistently. This is structural demand, not speculative, not temporary, long-term, fundamental, growing demand. Now let me connect these 3 forces. Fed rate cuts narrow the interest rate differential. Chinese companies convert dollar holdings to yuan. That's short-term pressure. China's foreign exchange reserves at decade highs, shifting to gold, PBOC setting stronger midpoints. That's medium-term stability. CIPS is scaling at 40% annually, expanding into new regions, settling more trade in yuan. That's long-term structural demand. All 3 forces pushing in the same direction, all 3 accelerating right now. And here's what most people miss. These forces feed each other. As the yuan strengthens from Fed cuts, it makes holding yuan more attractive. Foreign investors who are scared of yuan depreciation start buying. That increases demand, which strengthens the currency more. As CIPS scales, more trade settles in yuan. Companies need to hold yuan balances. That creates persistent demand, which supports the currency. As China's reserves grow and shift to gold, confidence in yuan stability increases, which encourages more international use, which drives CIPS adoption. Virtuous cycle. But let me show you the complication. Because nothing in currency markets is simple, China's economy is struggling. November 2025 economic data was disappointing. Retail sales growth slowed sharply. Industrial output missed expectations. Fixed asset investment contracted more than anticipated. The property slump continues. Real estate investment falling. Home prices declining. This is not a healthy economy, and normally weak economy means weak currency. So why is the yuan strengthening despite weak economic data? 2 reasons. First, the Fed cuts matter more than China's economy right now. The interest rate differential is the dominant short-term driver, and that's moving in yuan's favor regardless of Chinese growth. Second, China is stimulus mode. December 2024. Politburo meeting signaled moderately loose monetary policy for 2025. First time since 2010. That means more interest rate cuts coming, more liquidity, more support for the economy. And markets are pricing in that support before it fully arrives. But here's the tension. If China cuts rates to stimulate the economy, that normally weakens the currency. Lower rates mean lower returns. Capital flows out. Currency falls. But China can't cut aggressively if the yuan is strengthening too much. Because yuan strength hurts exporters. Chinese goods become more expensive for foreign buyers. Exports decline. And exports are 20% of China's GDP. Can't afford to kill exports while the domestic economy is weak. So the PBOC is walking a tightrope. They need to cut rates to help the economy. But they can't let the yuan strengthen too much or they hurt exports. And they don't want the yuan to weaken too much or they undermine internationalization efforts. The Central Economic Work Conference in December 2025 made this clear. Keep the yuan basically stable at reasonable and balanced levels. Translation: we want controlled appreciation, not too fast, not too slow, managed strength. And this is where China's advantage comes in. They control their currency. The yuan isn't freely floating. The PBOC sets the midpoint. They intervene when needed. They have 3.346 trillion in reserves to use. They have capital controls that limit outflows. They can manage the pace of appreciation. That's very different from free market currencies that can spike or crash based on sentiment. China can guide the yuan higher gradually, and that's exactly what they're doing. Here's what this means practically. The yuan likely continues strengthening through 2026, not dramatically, not a straight line, but the trend is higher. And this has implications. For Chinese exporters, yuan strength makes their products more expensive, margins compress, they need to cut prices or accept lower profits. Some will struggle, especially in competitive sectors like electronics and textiles. But for Chinese importers, yuan strength is good news. Buying foreign goods, raw materials, energy gets cheaper. This helps sectors dependent on imports, manufacturing, construction, energy-intensive industries. For holders of dollar assets, yuan strength means your dollars buy fewer yuan. If you're a US investor looking at Chinese stocks, the currency move could offset some gains. If you're a Chinese citizen with dollar savings, you're losing value in yuan terms. For holders of yuan assets, it's the opposite. Your yuan appreciates against the dollar. If you bought yuan bonds or yuan deposits when the exchange rate was 7.3 and now it's 7.0, you gained 4% just from currency. That's on top of any interest earned. But here's the bigger picture. What yuan strength really signals. It signals the slow motion shift in global currency dynamics. The dollar isn't collapsing. Don't confuse short-term weakness with long-term collapse. The dollar is still 58% of global reserves, still 48% of international payments, still the dominant currency by far, but it's declining, slowly, steadily. The yuan is rising, from 2% of global reserves to 2.7%, from 3% of international payments to 4.113% by some measures. These aren't dramatic numbers, but the direction is clear, and the infrastructure is being built for acceleration. CIPS processing $24 trillion a year, growing 40% annually, bilateral currency swaps with over 30 countries worth 4.5 trillion yuan. Offshore yuan clearing centers in Hong Kong, Singapore, London, Frankfurt, now expanding to Brazil, Kazakhstan, digital yuan pilots for cross-border transactions. Every piece of infrastructure makes yuan usage easier. Every bit easier means more adoption. This is how currency transitions happen. Not overnight, over decades, gradually, then suddenly. Let me show you the historical parallel. When the British pound was the reserve currency, its decline took 30 years, from 1914 to 1944, slowly at first, then accelerating after World War II. The dollar's rise was gradual, infrastructure built over decades. Bretton Woods in 1944 formalized what market had already been moving toward. The yuan's rise is following the same pattern. Infrastructure first, CIPS, currency swaps, clearing centers, usage gradually increasing, critical mass building, then at some point, formalization. The yuan becomes an official alternative reserve currency. We're not there yet. We're maybe a third of the way through this process. The yuan is where the dollar was in the 1920s, emerging, growing, but not yet dominant. The full transition could take another 20 to 30 years. But the direction is set, the mechanisms are in place, and right now in late 2025 we're watching acceleration. The yuan just had its strongest year since 2020. CIPS just processed its highest volume ever. China's reserves just hit decade highs. Fed cuts just narrowed the interest rate differential. All the pieces aligning. Here's what people need to understand. Currency strength isn't just about numbers on a screen, it's about economic power. When your currency strengthens, you can buy more foreign goods for less. Your imports get cheaper. Your standard of living can rise without producing more. When your currency is used internationally, you gain advantages. You don't face currency risk in international transactions. You can run trade deficits without immediate consequences. You export inflation to the rest of the world. These are the benefits the US has enjoyed for 80 years. Dollar privilege, exorbitant privilege, and they're not going away tomorrow. But they're eroding, slowly, and Yuan strength is part of that erosion. For China, a stronger yuan is a double-edged sword. Short-term, it hurts exports, but long-term, it advances their strategic goals: currency credibility, reserve status, global influence. The PBOC clearly chose the long-term path. They're letting the yuan appreciate. They're building CIPS. They're internationalizing the currency. They understand that true global power comes not from having the cheapest exports, but from having the most trusted currency. And trust takes time to build. The yuan still faces skepticism, capital controls, limited convertibility, authoritarian government that could freeze assets. These are legitimate concerns, and they limit how far the yuan can rise as a reserve currency. You can't be the global reserve currency with capital controls. People need to be able to move money freely in and out. China hasn't solved this yet. Maybe they never will. But they're making progress, gradually liberalizing, selectively opening, testing and learning. Let me end with this. The yuan at 704 today isn't just a number, it's a signal. A signal that global currency dynamics are shifting, that alternatives to the dollar are becoming viable, that infrastructure matters, that patient strategic planning pays off over decades. The yuan's strength in 2025 comes from Fed rate cuts, reserve accumulation, and CIPS scaling. Three forces, all pointing the same direction, all accelerating. And while the yuan won't replace the dollar anytime soon, it's carving out an increasingly important role: second most used trade currency, third most used payment currency, growing share of reserves. These aren't predictions, these are facts, current reality, and the trajectory is clear. As Fed cuts continue through 2026, the interest rate differential narrows more. As CIPS scales another 40% next year, yuan trade increases. As more countries join bilateral swap agreements, yuan liquidity improves. The mechanisms driving yuan's strength aren't temporary. They're structural. They're not going away. And understanding this isn't just about predicting exchange rates. It's about understanding where global finance is heading, which systems are growing, which are shrinking, which currencies are gaining trust, which are losing it. The yuan hitting 14-month highs in December 2025 is the story, but the mechanisms behind it, the Fed, the reserves, the CIPS infrastructure, that's the lesson. Currency strength isn't magic, it's mechanics, interest rate differentials, capital flows, payment infrastructure, reserve accumulation, policy signals, all measurable, all trackable, all pointing the same direction. And right now, that direction is yuan appreciation. Not dramatic, not sudden, but persistent, steady, structural. And that's the story most people are missing while they focus on daily price moves and headlines about currency manipulation. The real story is infrastructure. The real story is time. The real story is patient strategic execution over decades. And on that measure, China is winning.